Our next guest says 2021 will be a battle of liquidity versus valuation. Here to explain his thoughts, Michael Lee, founder, Michael Lee Strategy. So tell me, liquidity versus valuation, what does this mean? What does this play out in 2021? What do you think happens?
Well, how's it going, Nicole? So first, I would say that we are at a point where stocks are very close, if not at, however you want to judge it, historical valuations. So stocks are by no means cheap right now. You're looking at anywhere from 21 to 24 times forward-looking earnings, the S&P 500, depending on the numbers you're using. In the dot-com boom, we got to about a 25. So that's pretty far stretched, but just because stocks are expensive doesn't mean they won't get more expensive. And what I think is driving this is a multitude of factors. The most important being liquidity. So if you look at M2, which is the money in circulation, short-term deposits, savings, short-term treasuries, money market funds, how much cash is out there in the system, that's going to go from about 15 trillion this time last year to about 20 trillion once this next stimulus bill is passed. So you basically increase the money supply by a third. And what that does, that inflates financial asset values. So that, I think, is one of the key drivers. You also have the Fed keeping the front end of the interest rate curve at zero, in addition to buying $1.4 trillion of mortgages and treasuries every single year. So that all that liquidity coming in the market, it pushes stocks higher. It's been the story since 2010, and I don't see that stopping.
All right, so you have liquidity, not only from the Fed, but fiscal stimulus. You see this M2 on the rise, money supply, money everywhere. And then how do you make money? Because I know that you have certain areas that you like investing in, right? Retail and biotech, you were looking at those ETFs. Tell me how you play that.
Yes, so the easiest way to I would say take advantage of retail. So we saw a gangbusters retail sales number coming out today. A lot of that had to do with the $600 checks that went out that I don't think have made their entire way through the system. What you're seeing in retail is you're seeing revenue and sales at all-time highs and inventories at or near all-time lows. That is a profit nirvana for retail stocks. My favorite pick is Target. They don't report till March 2nd. I expect them to have really good numbers. It's a management story there in terms of being able to turn around all the different issues they have, being able to deliver on an omni-channel basis. But the easy way to play it is XRT. It's a retail S&P Spider Sector retail specific ETF. I think you can play this, the growing consumer, recovering economy, and a lot of this liquidity that's out there, people that are not traveling, people that are buying homes and moving to larger living spaces and fixing up their homes. All that plays out. All these thematic trends play out in retail, along with this sales to inventory situation that we're in temporarily for some great earnings we're going to see over the next few weeks. And then the other name I like is the biotech sector. I think we're at the we're still near the beginning stages of a multi-year breakout on the back of the coronavirus and a lot of the vaccine development. That's all going to play out. So I've been talking about XBI on your show since I think it was at 115. Yeah. We're up in the 150s now. It got up to 170. So it's a little bit of a dip, a great opportunity, I would say, to buy right here.
Ah, okay. I like it. How about some other areas? For example, financials, which may do very well from the trading volume that we've been seeing with everything from Reddit, and everybody's gotten crazy. And we're seeing some of these, financials, these brokers have been trading a lot too. Do you think financials is a good play for 2021?
Yeah, financials have had a tremendous move. And I think the story with financials, in addition to the trading bonanza and the IPO bonanza, is the steepening of the yield curve. So if you look at the difference between, the 2-year Treasury and the 30-year Treasuries, is the widest it's been. We're at or near wides post-financial crisis. So the ability for large financial institutions to borrow overnight for nothing and reinvest it on the long run, that net interest margin, that interest spread, I think this movement of the 30-year out to above 2% is the biggest catalyst that these banks have seen in quite some times. When the banks take off and rally like this, it's generally a great sign for for the overall markets. Typically, financials have to have another leg higher, the rest of the market to move higher. So that difference between the short term and the long term, the yield curve, that slope, is as wide as it's been in, like I said, basically post-crisis.
Right.
So I do like the financials. I think the play there is Wells Fargo. If management can turn it around, I think they're going to figure out their issues. That stock has not recovered from the account opening scandal in 2015. So at some point they're going to clean up. They have a huge balance sheet, and they'll be able to take advantage of this market conditions we're seeing right now.
A few seconds on the cruise lines, airlines, hotels, casinos, any of those interesting to you?
Yeah, no. I would say
fair.
I'd say those are the ones.
You don't have to explain it. What about tech? Is there something in tech that you love?
I play that the easy way with the XLK. It's down today. It's another opportunity to get in. The big names in tech aren't going anywhere.
Yeah, Michael, it's always great to chat with you. I always appreciate your insight, no doubt. Do you think the S&P is higher by the end of the year?
Much higher.
All right, do you have a target?
Yeah, look,
Roughly?
we'll be, I think, in the 4,100 range. 4,100, 4,200 in there.
All right, Michael, thank you. Michael Lee, founder, Michael Lee Strategy.